Hello, everyone, and welcome to Navigating the Startup Ecosystem as a Female Founder. And I'd like to invite anybody to ask any questions as we go through today. Please feel free to add the questions, any of the questions, raise your hand if you'd like to come on screen. This is a little bit of a go back and forth. So please do feel comfortable to ask questions. My name is Cindy Guillon, and I'm the founder and CEO of Linking Ventures. And I've been navigating the startup ecosystem for decades, and in a number of a variety of different roles. And a couple of companies ago, I was actually brought in to defend a valuation for an early stage startup. And that helped me start to unpack a lot of information about how we navigate startups, the startup process very differently as female founders. And that's what we'll be talking about today. All right. And just so that you know, we are recording this and it is being live streamed onto YouTube. So if you do have to jump out early, you will be able to you'll be able to find this later on as well. All right, I'm just going to share my screen with you. And if someone can come off mute for a second and just let me know if you're able to see my my screen. And just want to make sure that you're able to hear me as well. All right. Very good. So navigating early funding and valuations as a female founders. Changing how startups start. Again, I am open and available for anybody who'd like to reach out. Cindy C. Guillon at linkingventures.com is my email address. Our website is www.linkingventures.com. Please follow us on Twitter, at Linking Ventures, and Instagram at Linking Ventures, and our YouTube channel. You can find us at Linking Ventures. The more followers we have, the closer we'll get to be able to actually have a Linking Ventures YouTube address. So please follow us on YouTube as well. I will share that. Just connect out with me, and I'll share the link to this show, which will be on YouTube as well. A few startling facts. Women navigated funding differently. That's why we're here. Funding has dropped over the pandemic from 3 to 4% down to 2%, 0.03% for women of color. This is globally. Yet, the number of meetings with investors has gone up to an all-time high. Another point is that women actually bootstrap longer than male founders, on average about 3%. I know that's a large amount of time, and we're a little shocked by that. But yes, three years is usually on average how long a female founder will actually go before getting their first price round. Despite the fact that we as female leaders have a 34% higher return on investment, the difference of valuation is approximately 175%. And we are asked different questions, promotional versus preventative questions. Jacqueline Kennedy actually done a study on the types of questions that were asked, and we'll get a little bit more of that as well. One of the things we want to really discover is checkbox change versus actionable change. And what that means is checkbox change is, well, we have that 2% funding that is available, and yet we're seeing all of these checks come out, or all of this funding come out to female founders. So that's checkbox change, because these checks are likely quite small. So you'll have a few token large checks, but we're not seeing many investors leading rounds. Therefore, the check sizes are much smaller. That would be an example of checkbox change. So moving our investors into more of a lead investor would be an actionable change. So I love to kind of give this one story from an amazing founder that I had met. And I was actually a member of the Canadian Ski Patrol for 25 years as well. And we teach the universal signs and symptoms of a heart attack as being the crushing sensation in the chest and the radiation of pain up and down the left arm. These universal signs and symptoms do not apply to women to the point where it's very hard for a female to understand and to know when she's having a heart attack. And this is because the research has not been done. So that is the research being applied then is just checkbox change. So we need to actually go in and uncover this. And this amazing founder I mentioned, she's developed a cardio health platform specifically designed for women of color. There's a number of these elements and unconscious bias that we need to start unpacking throughout this. So how do we step beyond this? Well, there's a story behind your numbers. Right from this very get-go, for everything you do now moving forward as a female founder, I want you to uncover and think about every time you speak to somebody about your company to talk about your story, right? Because I love this quote. I had the chance to see Dr. Jane Goodall speak, and she's just an amazing speaker. And this quote came out of that speech. If you want to change someone's mind, you must change their heart. And the only way to do this is through stories, right? The more we talk about our stories, the more we kind of wrap around people's unconscious bias, the easier it will be to change and to change their minds, right? To really have them associate and buy into and feel a part of, even if it's not affecting them directly, but to feel that they can empathize and understand what the story is. So everything we'll be talking about today I want you to start to think about how you can craft your story and build in that empathy and that needs based, that pain that you'll be solving with your product. But we're not talking about pitches. This is just what I want you to understand with everything that you hear in the startup world. Every mentor you talk to, I want you to grab the story components that they're giving you or attach that information to a version of the story as you interpret it. The best time to raise funds is when you have funds. Don't rush out for investment. There has become this massive culture around building up investment very quickly. I've got an idea. Okay, the next step I have to build up my clickable prototype. Okay, now I have to go and get funding. That's not the way it works. We're so used to seeing what I like to call hoodie entrepreneurs, and they ride in on their unicorns because they've dropped out of the right university and they swoop up that valuation that is unicorn status and ride off into the sunset to hopefully build something that's successful. That's not the stereotype that should be investable in this market. And honestly, that's why you're seeing a lot of down rounds with a lot of actually quite strong companies. As an example, fintech is one of the industries being hardest hit by these down rounds and these lower valuations. And it's interesting to kind of see how this kind of is all being played out. So don't rush into investment. I'm going to be giving you some information today that will help you slow down that process and make it a little bit more methodical and purposeful in how you start to navigate this. Okay. Dilution and value. So what is a valuation? I think that might be a really interesting place to start. Valuation is basically packaging your company up, everything you own, everything you've done, all your ideas, everything, in an attempt to sell the company. So if you think about it from a franchise level, then you've got all of these, like this actual equipment and a bricks and mortar building, so you can monetize it. That's where you get something like a 409A valuation or an accountant valuation. An accountant actually puts that valuation together, but they have something there that they can actually attach a value to. So, and that's where traditional valuations really kind of play out. Now, if we think about it in terms of being packaging it to sell, then you have to realize that if I take out this, let's say, car from the valuation, then that car then dilutes the pie as well. Or if I'm sharing the price of a car is a depreciating asset, so I don't actually probably use that as a wrong thing. But if you take out a piece of if somebody owns that piece of IP in that pie, then that actually dilutes it. So you now have a section of pie that's owned by this, but still a part of the company. It's always going to have a whole piece, a functioning circle, and all of these slivers that you're taking out are then allocated to certain individuals at certain times or certain people, but and it dilutes out how much the company maintains or owns at a time. And I know this sounds a little bit confusing, and that's where we get into the cap table, but I wanted you to kind of think about what dilution means and what value means. So if we think about then the valuation and being able to say this is what our value is, we also have to take a step back and realize that that value story and that dilution story needs to happen right away. Each time you go through a round, you will be diluting out your ownership then by about 10 to 30%. You also have to think about pre-money versus post-money, and these are words that you might come across when you're talking to an investor. So pre-money valuations means this is the value of the pie before you're telling me how much it's worth, okay, or before you're putting your investment in. Post-money means this is the value, including, I'm going to add the value of the company plus your investment, and that would then be the whole pie again. Okay, so understand pre-money versus post-money value is different. Pre-revenue versus post-revenue. Oh my goodness. So again, when you've got this wonderful accounting idea of a valuation, you're actually grabbing the future value and you're trying to attach it to tangible pieces of a company to be able to put a value to it. So when you put a value on pre-revenue, it's so hard to grab onto something to stick to. So, and I love to kind of tell this story. So you think about Dragon's Den and you think about Shark Tank and you think about founder after founder walking up and saying, my company's valued at $1 billion because I grabbed it from the internet, or somebody told me so, or an accountant gave me this information, whatever it might be. And the investors will laugh and the founders will cry. And that's because when you're at the earliest stages, that pre-revenue stage or that early revenue or early traction stage, there's really nothing there to stick to. Right? So all of these traditional valuation styles are primarily used for companies that have that revenue, that have something there to stick to. So do understand the difference between a pre-revenue valuation and post-revenue valuation, pre-money valuation versus post-money valuation. And I'm just trying to familiarize you a little bit with the terms so that when I get a little bit deeper into some of these parts that are important now, you'll have a bit more of that grounding to go for. So when I talk about rounds, I want to kind of break that down into how that dilutes out, right? If you think about water, how you kind of dilute, using water to kind of dilute out the taste of something strong, right? Funding goals for profitability. Every time you raise money, again, don't raise money when you need it. Make sure that when you're raising it, it is attached to your profitability goals, your revenue goals. So we usually kind of stretch that fund out to be able to put that money into place right away and be able to build it out to revenue. So that's the chunk of company you're thinking of in that next 12 to 18 months. 18 months is that wonderful kind of version of it. So that you're literally building and then revenue and building and revenue and building and revenue. So let's start with what that means from your first founders round. So a founders round, and I want to kind of take us all back because we're going equity right away. So we need an investor that's going to take equity from us right away. So that's not when your valuation story should start. or your dilution story starts. Your dilution story actually starts at the founders round. And I'll get into that a little bit more later. But on average, each one of these rounds, your founders round, pre-seed, seed, series A, B, C, D, it can go on until a liquidation event happens. Liquidation event is merger acquisition, company goes public, you sell the company outright. So these are all liquidation events, right? You sell your shares out, whatever it might be. So each one of these rounds then represents an opportunity to tell the value of what will happen when it does liquidate out. So dilution is about 10 to 30% per round. Okay, 10 to 20% per round. Okay. Some of the traditional values that are available are like discounted cash flow, the venture capital, and all of these are the traditional ones that really are in their comfort zone when they have revenue and traction to build on. So because they can grab those numbers, they're able to use it. You've got your comparable method. So a lot of these kind of talk about you've got what you have in place, what you've developed, but they also try to take a look into the industry and use something like a comparable, which is a value to sales ratio of a publicly traded company or an EBITDA to sales ratio of a publicly traded company. And what this does, because that's basically, I mean, that's a fun way to say that's how we can sell this Microsoft, right? So that's their version of their valuation, is that value to sales ratio is what they use to value that company in a way, right? So that's what they usually, that's what those comparables are used in a lot of these methods, traditional methods, to ground the company in an industry. So it helps to really kind of capture a little bit of the trendiness of the market at the time as well. Okay, the cost to duplicate method, liquidation value. These ones are a lot more when there's something tangible in place. Kaufman Foundation, Burkus method, which are fairly similar. Book value and Loyal VC. A number of these really kind of revolve around the numbers that are already established and in place. When you start to have things like early companies, there's really not a lot to base it on, and they rely a lot more on numbers from other companies, right? So remember I mentioned at the very beginning about that 175% difference between male-founded valuation companies that were evaluated and female-founded companies? Well, that's where this starts to come in for all these valuation methods. When they start to pull numbers in or information in that they've used to value other companies into a female-founded company or an underrepresented founders company, you're bringing in all this unconscious bias with this historical data, right? So 94% of historical data is biased when it comes to valuations. So you really need to kind of understand that as you evaluate a company out, it doesn't take into account how this company will be navigating differently. So it becomes a lot more art than science, right? So the science is the historical data, biased, comparables, biased, your financials, that's your own. But if you have no early financials, then it's based on, oh, we hope this. And historically, female founders are a lot more conservative when they talk about their financials, including their metrics and their KPIs. So something to be aware of. Please, everybody, avoid doing your 5-year financials. Stick to 3 years. It's a lot more, especially in the technology world, it's a lot more palpable. And then you get the art side of this. And this is your future projections, the trendiness of the market, your 5-year revenue and EBITDA. Again, please keep that down to 3 years, and past valuations. So you can see that a lot of the, when we're talking about early stage companies that don't yet have or have early traction in revenue, there's really not a lot of this science side to stick to. And then it becomes a lot more art. And I'd be happy to talk to you more about how we actually put the science and the math and the measurements back into valuations, and I'll talk to you a little bit about that closer to the end. So what I want to do, everything that I've talked about up till now has all been very focused on the investor's view. And it's not their fault, of course, because this is the life that they live. They're used to buying and selling, dilution conversations, cap table conversations, all these conversations. So what I want to do is I want to change that focus around so that it becomes a founder view, because we should be having these same due diligence conversations. We should be understanding our dilution as we maneuver through each of these stages of funding. We should have the ability to negotiate, the power to negotiate, the knowledge to be able to negotiate, and understanding of who comes into our company. And I say this because your first investor, your seed investor, first price round, that relationship with that lead investor will last longer than most co-founder relationships, than most North American marriages. And I do want to start, because I'm going to be using that vernacular a little bit more, marriage, because and dating, right? Because I want us all to kind of think about it in that extreme, because there is that relationship that does form. So let's take a look at this now from the founder's perspective. So when we talk about all of these different rounds, it is really a story of value and dilution through each of these seeds. And I want to kind of break that down into the founders round, your pre-seed round, and your seed round. That's all we're going to really talk about today. Once you get past that seed rounds, it really takes on a whole different life, in that we start talking about different classes of shares, different types of investors, different dilution methodologies. But you do need at these 3 rounds to be able to set the platform for all of this future growth to be able to take wing from. So what is a founders round? This is actually a pool here, because I really wanted to focus all of this founders round around your cap table and your option pool and your stock pool. So, and I mentioned that your value conversation should start as soon as you incorporate. So if you're not incorporated yet, please do incorporate, whether you do it at a state or provincial or smaller level or national level is truly up to you. It depends on how you're going to grow. But you want to make sure that you have the conversation with your co-founder if you have a co-founder. If you don't have a co-founder, you really need to think about that founding team and how that equity will break out there. So this first conversation, founder round, is your investment. And what does that mean, your investment? Well, your time is valuable. Every single penny that you put in for your media or your CRM or whatever it might be, that's money you're investing into the company. This is money. This is your investment into the company, your time equity into the company, the expenses that you might not ever get back. All of this for your founding team is very important to track right away, because this will actually be able to play out, and this is how you can talk about the value that your founding team is starting to build out. Okay, so that first round that comes in is coming from you guys and into your company, and you want to be able to showcase and talk about this with your investors later on and say, we did this and this and this. So please set something up now to start tracking the equity that you're putting into the company. Founder equity split, never do 50-50. Somebody has to be leading to be able to make these decisions. So do set that up. You can put a lot of this stuff together when you do anything that requires a signature. Please have a lawyer look that over. But a lot of times you can put this information together and then have a lawyer review it. There's a difference between having a lawyer review something and having a lawyer go through and put that together. Okay, so setting up your board as well. Please do incorporate and set up your board. I have an amazing book here that talks about, and I'm actually putting a book together now myself called Boards and Boxes, which is the female founder's perspective. But startup board, this is by Feld and Mahendra Ramsinghani. And this will give you some wonderful information, at least a base level on setting up a board. So usually you, at this early stage, you have yourself as the founder. So one internal, one external, and you leave space on your board for that investor in the future. Okay. But so if it's just you, then great. But I would recommend one internal, one external. It just gives you a nice balance of voices on the table. But set up that board meeting, set up a cap table. I will, let me just see. I have I'll share at the end of this. Please hang on. I'm going to share a bunch of links afterwards. But I do, there's a book that I have, and then Feld actually through his book, oh goodness, Venture Deals. There's a template in here for a cap table. There's a book from there's a whole series of these called the Founder Pocket Guide. And this one here, stock options, which you want to do to set up your option pool, and cap table. And there's a template in here, and I'll provide a couple of different templates. Carta has a cap table template here. So you can see there's lots of different versions of these. But what it does is it allows you to start thinking about how you dilute out. Right away on your cap table, you'll put your founder equity split on there, or your founder shares, and an option pool that should be a minimum of 10 to 15%. The reason why this is so important now is if you get out to your first price round and you haven't put that option pool, that employee option pool together, you have the possibility of diluting yourself out, because that investor will say, have you put together your option pool? You say no, they say, great, put that 10 to 15% on the caption pool right now. So you've just literally diluted yourself out by not having that together by an automatic 10 to 15% right then and there. And a lot of times when you get into future rounds, they'll actually add to that option pool. So they'll grow it with you. So please understand that it is so important for you to set up that option pool. An employee option pool, stock option pool is very important. This is what you're going to be using to draw from for your early hires. To entice them to come in, because, well, you may not be able to afford, honestly, you won't be able to afford, very rare to be able to afford bringing in your dream team, right? So you want to entice them with pieces of the pie, some equity components, as well as options. And all of these options, when we talk about options, you're also going to have like that cliff, right? So that cliff actually acts as a valuation. So that's when it converts out, right? Or at what point these valuations kind of can be exercised. There's a whole different set of information on option pool. I will share that at the end in the chat. So you'll have a couple of different opportunities to be able to play around with option pools and cap table. Okay. But founders round, very important. This is your first story of dilution, right? And again, this is the conversation that we are going to be building from founders round to the next one, which is your pre-seed round, right up to your seed level. So you're building your value story as you move through each of these funding opportunities to be able to say, this is the money that I put in, raised, however you want to talk about it. And this is what I did with the money. So now you're starting to attach the money that's coming into the company with the traction that you're getting and you're building out. So that's where the story through the numbers starts to build out. Pre-seed round. The majority of female founders skip right past this pre-seed round because they're too nervous of what we call it, the friends and family side of a pre-seed round, not realizing that the close associates are really the ones that we want to gravitate to the most. So a pre-seed round can be raised through non-investors, right? So that would be a close associate, and they might have a check size of like 10,000, right? And through something like a simple agreement for future equity, this is something that favors the founder. Convertible debt is exactly that, it's debt, and it favors the investor more. Um, and there's pros and cons to both sides of these. I will give information on this as well. It's important to research and understand both of these options, because you don't want to step away from something because you don't understand it. You want to walk into something understanding what a convertible debt is and what opportunity that might present if your favorite investor offers that to you, and what that safe might offer be to you as well. Right. So both convertible debt and safes do also have a valuation component, even though a lot of people will say it postpones the valuation story. It doesn't. You still are having a valuation story, and that's where that cap comes in, right? So when you start to put these elements into and start defining out the terms within the safe and convertible, there are elements in there that will talk about when it achieves this, then this will happen, right? So that is a valuation story as well, because they're saying in a future valuation, as an investor, I believe that this is going to happen, or as a founder, I know our company will achieve this at this point, and this is what's going to happen then, right? So that's where these elements are extremely important. So again, as a founder that's new to the country, or as an underrepresented founder, close associates is what you want to do. Please don't skip by your pre-seed round. Now, pre-seed rounds tend to be a lot lower, right? They max out at 500K usually. I mean, I have seen them go up to $1 million, but they're a smaller round, and they really kind of help you build out the framework to balance your traction and your revenue, right? This is to prove out your idea, test your hypotheses, and really kind of establish that you do actually have something that is investable. And I have two books that are my favorite here, which is Traction. And Traction is by Gabriel Weinberg and Justin Myers. And so Gabriel Weinberg is one of the co-founders of DuckDuckGo. And if anybody knows who DuckDuckGo is, it's a search engine. And if they can take on Google doing in the industry of what they do best, then you know you got something. So it is critical through each of your elements to balance traction and product development. Okay. And this pre-seed round is so critical for establishing what that means. I'm also going to give a shout out to April Dunford and Obviously Awesome, and this kind of some of the tools that you can use to help you establish the personas, and nailing that product positioning side of things. So some of my little go-tos for that side of things. And a lot of the stuff I'm working through myself, right? So anytime that I come across something new, I do try to share that information. But again, pre-seed round, please don't skip by it. This is your opportunity to really flesh out whether you have a viable idea, and to work on getting at least that clickable MVP out and going, and run your hypothesis and checks and balances. Okay. Your seed round. Well, seed round is really reverse due diligence. And I really want us to think about it this way. Again, this is establishing your investor profile as you kind of grow. This is such a pivotal and extremely important. Your first investor, again, you want to kind of run a whole dating scenario, which I'll get to on the next slide, to find that perfect investor that you lulled in love with. I have this wonderful Rindersella story that I do that reverses everything, so that you've fallen in love with, and that you want to marry, right? That's the thought process I want you to think of when you find your first lead investor. It is so important. And this seed investment, you need to go through and establish what strategies you're going to enact and how those pieces parse out. So my talent acquisition, my product development, my traction and product development strategy is this, and it's going to cost me this. And I know if I put this money into this strategy right away, this is how it's going to play out. In order to support that, I need this talent acquisition. These are the people I need. This is how much it's going to cost. I need this intellectual property to be able to protect all of this. So this is how much my data security and data privacy is this. So all of these elements come with a strategy. You've got the quotes, and you know when you get that money, you're going to be able to enact it right away. That's how you need to think of what this seed level is, okay? And you're building up your valuation story to be able to find the funding to be able to value the company at the amount that you can go through and attach to these strategies and fund these strategies. Thinking again out to that 12 to 18 months, this seed will get you out to that revenue within 12 to 18 months. And then once you've achieved that revenue and you're doing well again, because you've completed that component of your traction and product development, you move on to the next big piece and you kind of keep moving forward from there. So what does that seed preparation look like? And what does that reverse due diligence look like? I keep talking about having that investor that you want to marry. I want each of you, take a screenshot of this, whatever you'd like. I took over the summer, I took a wonderful course that was put on by Techstars and Venture Deals, Brad Feld's group, and Nicole Glaris was one of the speakers in there, and she talked about putting together this wonderful spreadsheet. So a lot of this information is from that talk, and I want each of you to put together a spreadsheet today that has each one of these topics, because this is what you're going to use as your dating app. Okay, so first of all, when you're talking to an investor, when you're thinking about an investor, they are a person first. Always talk to them, the human being side of them. They are a human being first. That's why you put the person's name first. Then you can put the firm, the geo. We are no longer limited to a geography or municipality, or we now have the ability to go beyond just our front door for investment. So attach the geo to it as well. The average check size, if you can find that information out, very important. Do they lead around? A, B, or C investor. What does that mean? A, B, or C investor. A C investor is somebody who has the money, or an outfit that has the money, but it doesn't attach to any strategy. And remember, I was saying how important strategy is at the seed level. It is so critical to make sure that there's a good match with the money that you're bringing in, that there's a strategic match with the money that you're bringing in, because you don't want to raise money when you're desperate for money. Therefore, the C-level investor is when you're desperate for money and you don't want to invest, you don't want to bring in money when you're desperate for it. So C-level investor kind of sits off on the side. It's money that you would only take in a desperate situation, but it does not fit. Your B-level investor are in the right industry. These are the investors that you would love to date, but you may not bring home to mom. So what that means is that they also might be a follow-on investor, right? So, and they're an opportunity, they're in the right industry. There's some great, there might be some great alignment. You might have a little bit of fun and learning from them, but they will very unlikely be that lead investor. So, and it gives you an opportunity to play around, and hold on, let me just talk about the A investor. So then the A investor are the investors that are the perfect fit that you want to marry. Again, these relationships will last longer than most co-founder relationship, than most business relationships that you have, than most North American marriages, right? So it's important to get them right. This B pool that you put together is an opportunity for you to go through and have conversations and date and practice your pitch. And as you go through, you're able to hone in. And I talked about the preventative questions versus promotional questions very briefly. So Jacqueline Kennedy has put together a research study on these preventative questions versus promotional questions. So female founders are asked preventative questions, things like, and I'm sure we've all heard it, wow, that's a very saturated market. I know this competitor, this competitor, this competitor, this competitor. How are you ever going to compete in such a saturated market? What a defeatist question, right? Rather than promotional questions, which would be something as simple as, well, that is a great idea. Can you talk a little bit about how you're going to compete? Which is a promotional, right? But what we want to do is we want to take this preventative question and turn it around so that it becomes promotional, right? And that promotional response then would be something like, well, we have, oh, are you asking us about our go-to-market strategy? So you've kind of taken back the wheel there and you're like, oh, and if they're going to say yes, then you've been able to kind of curtail and guide the questions down a certain path. And if they say, no, I've heard this all before, they're in your C list. I mean, you've had the conversation, put them in your C list. But the B ones, you'll be able to change the narrative, right? So this is where we start to flesh out what those conversations end up being like. You start to build out the questions that are being asked of you through these B investors. So, are they a good fit? What are some of the primary questions that they ask? Alexander Jarvis, I'll share the link to him as well. He's got an amazing set of financial questions and how to respond to them. And I would suggest that you go and look this up so that you are prepared to answer your questions that may be posed to you in a preventative way in a promotional response. Okay, so if you have all your information, all your knowledge, and you're able to respond to these questions and build up this question list with your B levels, by the time you get to that A level investor, and trust me, you'll have done enough pitching with your B level investors that all of a sudden they'll be like, oh my gosh, they are getting what I'm putting down. They like this, right? So at that point, you'll be able to make that transition into your A investors. Now, here's what I want you to do with your A investors. I don't want you to approach them to pitch at all, but I do want you to figure out a way to get on their radar and give them something. Find out what they're researching, what they're interested in. Investors are innately curious, right? So there's always something that they're interested in, and specifically around the industries that they invest in. So hook up with them, find out that's one of the other ones I would add to this list here. Find out what their preferred method of communication is. Do they do a lot of, are they on Twitter? Are they active on LinkedIn? Are they active on Meta, Instagram? Find out what their primary modality, or it could be email and it could be phone calls. Find out what they prefer to use for communication, and then reach out to them with an article in their industry and say, and connect with them and say, or if you've seen them speak recently, say, wow, this is what I learned from what you said. Might we connect? And then later on, just here's an article I saw that I thought you might be interested. But at this stage of the game, while you're playing and dating with your Bs, you want to be on the radar of your A investors to say, here's my intelligence, this is what I'm building out, and this is what I can give for you. If there's any opportunity to give them something, make sure that you take it, right? If they're looking for guest speaking opportunities, find those for them. help them out, if they're looking for places to share their blog, share that, or put a comment on what you've learned from their podcast or blog, something along those lines, right? So get on their radar, start to give them stuff, right? Mark the stage of your process. So lead, I've just found them, that you've given them the information already, emailed, whatever it might be. So you also want to make sure that you understand, this is something really interesting that Nicole, and I didn't know this before, I'd heard it from her. You want to know the vintage of the fund, right? So just like us as founders are raising money for our company, these investors raise funds for their fund. So they are doing the exact same process as we're doing, but to raise funds for their funds, right? That's where they bring in those limited partners, those LPs into their fund, and they're investing in their fund, right? So find out how early, if you're at the very tail end of a fund, they're just, it's not a very excited investment. So you want to be right at the very early stages when they just close that fund. So do go on, follow a number of VCs, especially your favorite VCs or angel syndicates, so that you can keep your eye on when these new funds are being raised or have just been closed. Okay. And of course, keep track of whether you think some of these B investors that you've met with might be interested in a follow-on round. So, and track all that stuff as well. Okay. Adding science through metrics. Now, this is where we start talking a little bit about what Linking Ventures does. So Linking Ventures is essentially a valuations platform that immerses you, the founder, into your valuations based on the fact that what gets measured gets done. So we talked earlier about how valuations are very art and science, and at the earliest stages, when there's really nothing to grab onto, it becomes a lot more art. So through our platform, which actually produces multiple valuations, so in a week, if you achieve a number of milestones, you would be clicking on a number of valuations to be able to track it. So it tracks your value at the same time as giving you something defensible, because you want to be able to get to your seed level investor and have a negotiation conversation about valuation, right? But you also want to be able to track all your value events as you go through it. So it will go up and down, because at the earliest stages, let's face it, we pivot. So, and the more you interact with the system, the more solid your valuation becomes. What the valuation then does, once you get into that seed level valuation, all future valuations will be based on the work that you've achieved in your earliest stages, and the work that you're doing forward. So all traditional valuations would be able to build off of this. So we actually have custom value metrics, and we all start from a baseline valuation, which is something that you can use very early on for your for just establishing your cap table and your founder's equity round, right? That's the baseline valuation. The value metrics that we have in place is really a dashboard that tells you at any given time, oh, I'm way too focused on my product and not enough on my traction, or oh my gosh, my team is all business, all business. There's no party in the back, right? So you need to get some technology to offset the balance. And it also talks about your governance and the balance there within your whole team from a diversity, equity, equitability, and inclusion perspective. So that at any given time, you can take a look and see what balance pieces, components, where you need to work on to actually be able to build out more of a balance. And it does actually help you, because you're watching your value go up and down. It does give you some insight into when you should go out for a raise or ask for money. And because you're also being the system is also influenced by your strategy and how much you're putting into monetarily, how much you're going to be spending on each of those strategies. That component also plays an element into all of this as well. So each milestone then is triggering a valuation that you're able to track over a series of however long it's going to take you to go up into that first seed round. Okay, and it is a subscription-based model. So we do bring in the a number of metrics to help ground out the industry. We work from the 3-year revenue EBITDA. And your founder's investment, there is a time equity tracker, an expense equity tracker in the system for the co-founder, founder, and the founding team as well. It does play a very important part. We find that little research that we've done is that technology team members tend to be left out, even though because they're not as in front and loud. So that equity, that time equity investment sometimes gets a little bit lost. So being able to have your founding team tracking this information out is very important. Okay. We're changing how startups start. I want to say again, when we try to affect change from a corporate level, we need to monetize it very quickly. When we try to affect change from the government level, it happens very slow, if at all, and then they might get voted out. If we stand strong and proud for whatever underrepresented founder we might be, or person we might be in whatever situation, we've seen how that doesn't end very positively. So what we as founders then can do is we can change and affect change at the most malleable point of everything, right? We have the ears and eyes of early adapters. So what we build as we go forward has the ability to change something at the ground level. So as you build out your company, I want you to think about the universal voice that you have because you're in a unique situation of being a founder and you're starting something new. So build out everything with an inclusive design right off the top. When you're thinking about your niche market, I want you to unpack each component of that to understand all the different aspects of that. And I heard this phrase recently, and I absolutely love it. If you're, and I'm sorry, I forget who said it. If you're the smartest person in the room, you're in the wrong room. So think about that when you build out your team, and make sure that your governance reflects your product development. So if you have a table that's set up of just one side of your demographic, you're not going to get all of those voices represented as you develop your product. So what that means then is if you have just take an opportunity to say, okay, this is how somebody who is visually impaired might navigate through my product. Okay. And have that persona walk through your, just visually walk through your product. And as you build out your personas, build out these different types of personas. And if this is, and if this represents a large aspect of change, I want you to see about or think about or consider putting somebody that represents that voice on your board so that they can reflect that change in your product as you build it. I had an opportunity to speak with 50 founders, male founders, and I asked them to talk about the persona and have that persona walk through their product. And then I said, well, can you please, none of the, you even as a female founder, we automatically default to a male persona unless we're specifically designing in femtech, or a lot of us do. So, and I asked them to say, okay, well, can you just tell me how that female persona would navigate through it? And all of them took me through that process, and just having them have that discussion changed their perspective on their product. Now, oh, I can add this. Oh, I can add this. And they automatically saw the revenue side of it by opening it up. Right. So please do this, consider your universal design and governance. This is also something that we do give value to in our valuations platform. It is important. And another aspect is environmental concerns. We don't think about something like this streaming call, the amount of data power that this actually takes, right? And then you think about the data servers that are going crazy with all this data flowing back and forth, right? So what impact does your company have, even if you're a SaaS, on the environment? And are you making the right choices on who you're using to as your partner for your data storage, for example, that they're environmentally conscious as well. So start to consider all of these things. We're shaping everything at this early stage, so let's take advantage of that and make the wise choices. Data privacy and cybersecurity are also critical components. Set the platform for that right now as we kind of move forward. All of this is about setting the stage for not that unicorn, because unicorns are mythical creatures. We want to set the stage for duck-billed platypuses because for all their uniqueness, they're grounded in reality. Okay, so valuation standard for early stage startups. We have a couple of different things that we do for speaking. One of them is the first Tuesday of every month. We have something called the Breakout Room, where we explore from a number of different perspectives, but always start up, how we can affect change and matching diversity, equity, and inclusion to governance within our startups, and how we can change how startups start and how we can affect change from our startups. The next one in November will be focused on IP, intellectual property, and the one in December will be focused on governance. So please join us. I will include the links to that as well. Please reach out to me. Anybody that's here today, reach out to me on LinkedIn. And if you're interested, please let me know in subscribing to Linking Ventures. We're just pushing out the next version, but if you're interested in coming in doing a prepay, the next version that you'd be entitled to would come along with my advice as well. We'll be doing a group advice for anybody that is on the platform subscribing, doing a pre-subscription for the model once a week. And it'll be like a group session. She'll be a lot more open conversations on what the woes are of your early stage issues that you're having as you navigate through. And of course, being able to set all the valuations to your milestones will be available actually right away. We do have a working model going right away. Follow us on Facebook, follow us on LinkedIn, Twitter, Instagram, and please search out this recording and follow us on YouTube so that we can actually get a branded Linking Ventures YouTube platform. And I'd like to open it up to if anybody has any questions. And if anybody has any questions, please feel free to put them into the chat. And it looks like we have like a minute left. I've been pretty good on timing. But all to say, it is really important for you to establish a framework and an understanding for the value. Do your reverse due diligence. They're doing the due diligence on you. You need to do the due diligence on the investor as well. I love to end all of these with a wonderful story because it helps me go. It's what I think when I feel down. When I was young in grade school, I saw my friend on the way home from school, and I ran up to her at the top of my lungs screaming, "Hilda, Hilda, 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 Hilda." And I got up super close and realized it wasn't her. So I kept running around the corner and waving, "Hilda, Hilda, 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 Hilda." So if things get you down and you feel like you're a little bit out of sorts, just keep running and waving. So thank you, everybody. It was wonderful to chat and share this knowledge. And I will certainly share more of this information at your request. Thank you so much. Have an amazing day.